Hello and welcome. You're watching us here on Halftime Report. But before that, let's talk about all the top stories that we're tracking this afternoon. Stocks wilt under pressure, and that's primarily on account of the weakness that we're seeing in the global markets, and as a result of which Nifty also holding around that 17,700 mark.
Jio adds the most subscribers in July, adding 29.5 lakh customers, while Bharti adds 5 lakh. Even broadband subscribers additions are strong.
The Vedanta stock reverses some gains after it clarifies that its semiconductor foray will not be through the listed arm, unlike what Chairman Anil Agarwal perhaps inadvertently told CNBC-TV18 in an exclusive chat.
Optimism over their drug launch pipeline powers Big Pharma counters higher. Analysts turn bullish on Cipla, Dr. Reddy's.
Hello and welcome. You're watching us here on Halftime Report. I'm Mangla Malu, with me Ekta Batra. Well, it's a Friday, so you can, discount a couple of slips here and there. But, for the market, it has been slipping below that 17,700 mark. And that was a place of support for us below the 20-day moving average is something. Let's see whether it sustains here or whether it finds support in this zone or not. But as of now, it looks like global weakness is weighing down on our markets.
Yes, absolutely. As you can see, the Bank Nifty is down around 0.4%, and it has been largely resilient, you'd have to say, the Bank Nifty, considering that it touched record highs on an intraday basis in yesterday's trading session. Midcap index down over 350 odd points, and the Nifty down over 200 odd points at this point in time. So we have a lot to discuss over the next 60 minutes odd. But maybe we can get to our first stock that we're tracking today, which is Vedanta. The company has clarified that the business of manufacturing semiconductors will not be under Vedanta. Vivek Iyer is standing by with the details. He's tracking this story. Vivek, over to you.
Well, that's right. So there has been quite a bit of flip-flop in terms of how exactly and under which entity will Vedanta be housing this particular semiconductor business that is, that it is undertaking in partnership with Foxconn. So initially in Feb 2022, the management had said that any semiconductor business operations would be done under the holding company, that is Vulcan Investments. However, in the past couple of days, the management had indicated that this particular semiconductor business operations would be done under the listed entity, leading to quite a bit of exuberance as far as the stock price was concerned. However, another flip-flop, the management clarified, to the exchanges, saying that this particular operations of the semiconductor business would now be housed under the eventual holding parent company of Vedanta, that is Vulcan Investments, and this has in fact led to quite a bit of tapering off as far as the stock of Vedanta is concerned. This has led to some amount of concerns as far as capital allocation policies is concerned, and whether Vulcan Investments will need any cash flow from Vedanta operations.
All right, take that point, Vivek. Thank you so much for joining in. Escorts Kubota is also, in focus. It's simplified the company's organizational structure and announced the amalgamation of Escorts Kubota and Kubota Agri. What does this mean? Sonia joins in with the details. Sonia.
Well, as you rightly said, it's just a simplification of the organizational structure, right? They have two JV companies and they have amalgamated both, brought it under one umbrella entity. And what this does is help increase efficiencies in operations. They will consolidate their diversified product and services portfolio under one umbrella. And this is in order to have a larger market footprint, both domestically as well as globally. Now, this will ensure optimization of resources, of working capital utilization, reduction in management overlays. So for the longer term, it is of course beneficial, the simplification of the structure. It will also reduce the legal and regulatory compliances. But then why is the stock under pressure? Credit Suisse put out a note this morning where they said that this amalgamation will be 6% EPS dilutive due to the JVs being loss-making. Both the JVs are loss-making, hence there will be some EPS dilution, and that is reflecting in the stock. Post-amalgamation, though, a simplified legal structure with all operations under one entity is a big positive. However, let's remember that the overall industry has also been on a slow growth path. Credit Suisse says that the tractor industry will continue to deliver low single-digit growth in FY23. And for Escorts Kubota particularly, they've lost some amount of market share to peers like M&M, and the demand in the operating regions for Escorts Kubota is relatively muted, hence they maintain a neutral on the stock. But overall, the amalgamation of the two JV companies is definitely a positive in the longer run. Back to you.
Okay, all right, Sonia, thanks very much for that. So that's on Escorts, the stock down around 1.5%. But Cipla is managing to hold its head above the water in what is a tough market today. And the reason why Cipla is managing to do that, it's up around 2% at this point in time, is because Jefferies has written on it. They have a buy. They've raised the target price to 12.23 versus 11.44 earlier. According to them, upcoming launches and the pipeline looks strong. And they've revised their US and margin estimates given the strong product launches on the horizon. So they've revised the FY23 estimated EPS upwards by 4%, FY24 estimated EPS by 3%, and they've revised the FY24 EBITDA margins to around 24.2% versus 23.3% on Cipla. So that's a bullish call which is coming in, Mangalam.
A bullish call and reacting accordingly as well. One of the top gainers today or today's trading session in an otherwise weak looking screen. Weak given the sort of rally that we've seen in the last couple of trading sessions, so it does not look as bad. We're still sitting with gains and outperforming the global markets, but today perhaps in step with the weakness that we're seeing across the globe too. But we do have a fair amount of index rebalances. Vivek joins in back again to tell us about both Sensex as well as the FTSE rebalance.
Well, that's right. In fact, when you're talking about these particular rebalances, couple of rebalances that you mentioned, both Sensex and FTSE, and what typically happens is that passive funds will now have to go ahead and change the allocation in their particular portfolio as per the changes made in the indices. So the first one, when you're talking about today's trading session, you're expecting significant spike as far as the trading volumes in some of the stocks that we mentioned. So there'll be a significant activity and a significant comparative rise when you're comparing it to the typical daily trading average volume. Now, the other thing that you have to look out for is whether the stock is a fresh inclusion or whether it's an increase in the weightage. So first, let's have a look at Sensex. There have been no changes as far as the constituents are concerned, but what we are tracking is adjustment of weight upwards. So Sensex, Kotak Mahindra Bank and IndusInd Bank both are seeing a significant weight upwards of $44 million and $11 million respectively. On the other hand, SBI and HCL Tech both will see a slight downward revision as far as the weight is concerned. When you're coming to FTSE, both inclusions, exclusions as well as weight changes, quite a few. We've highlighted the top ones. First is Indian Hotels. Now this particular stock will see a weightage inflow or a passive flow of close to $45 million in today's trading session. CG Power around $34 million. Gujarat Fluorochem $25 million. Schaeffler India around $26 million. And again, Linde India and Motherson Sumi. On the other hand, two stocks that are noteworthy in terms of the outflows that they are expected to see is Indiabulls Housing Finance and Tata Power. Tata, in fact, is expected to see close to $20 million worth of selling in today's trading session. What needs to be kept in mind is that active fund managers typically price in this particular event. So it'll be interesting to see how exactly the price moves. But one thing is you can be assured of is the fact that trading volumes here will spike quite significantly.
Take that point. Thanks a lot, Vivek, for joining in and talking us through all those stocks which will be in focus. With that, we'll step to a short break. On the other side, we'll get you an update on the pharmaceutical space. Over 30 drugs regularly used by patients have now become more affordable because of the NPPA regulations, the NLEM, or the National List of Essential Medicines list that was released recently. We'll get you a lowdown on that. Welcome back. The market slipped a little more virtually at the low point of trade for the Nifty, and that's courtesy a couple of these heavyweights, stocks as well as sectors. So pull up the intraday chart of Reliance and you'll see that, there's been some incremental weakness out there. Reliance is currently at the low point of trade, and by virtue of its weight, it's actually dragged the Nifty 1,650 odd. Giving it company on the downside are the IT stocks, which have been underperforming for all through this year. We did see a brief uptick in these stocks at the start of the week, but that's come down once again. The IT index is at the low point of trade, led lower by both Infosys as well as TCS, among other stocks. So these are a bunch of heavyweights which are not doing too well for the markets, and that's reflecting in the way we are seeing a decline in the Nifty itself. The Nifty Bank is outperforming with a cut of just about 0.5% as against the Nifty, which is down 1.2%. But time now to get you another corporate interaction. My colleague Shilpa caught up with Rajendra Kalkar, who's the president of malls at Phoenix Mills. Let's hear out what he had to say, especially with regard to the demand in the festive period.
I think consumption levels have gone very, very good. As compared to 1920, the growth levels across India, if you see retail per se, if you see all the numbers, they are at 20-25% over 1920. So growth is happening, and it is happening across categories. Footfalls, I would say, as compared to 1920, they have just reached about 80-90% levels. They have not crossed the 1920 levels. But what has happened is, maybe earlier there were more window shoppers who were just coming for time pass to the mall. I think these days everybody who's coming is actually coming with a dedicated mind that he needs to buy or dine or entertain himself. So it is more of shoppers that we are seeing, serious shoppers than actually window shoppers. Okay. So more or less the footfalls have reached back at about 90% levels. Okay. So far as future is concerned, I am presuming this Diwali Christmas season would be, I think, one of the best that people would have seen. Last May, everybody said that this is the best May they have seen in the last 20 years in retail. But I am saying that maybe this October, November would be perhaps much, much better and unprecedented. People will see really good shopping happening across categories.
Right. So do you think the festive season then the footfalls will reach 100% of pre-COVID levels?
I am presuming that. I'm actually hoping it will cross that.
Okay, right. And I wanted to understand about rental incomes also. Now that dipped during the pandemic because there was a lot of concessions given. I think starting late last year, all the concessions were taken away and full rentals were restored. So have you seen a full recovery when it comes to your rental income, and what's the growth been there like?
So during pandemic also, the rental incomes were the same. It's only that for the COVID period, concessions were given. It's not that the agreements were changed or it was the entire reneg was not there. So the concessions are not there. So it's a normal what was going on. If it was a 5-year, 10-year agreement, the 2 years have had a dip, but now they are back to normal levels what they have to be, and not going very far, but taking a very short-term look at the new malls. Indore is the one which is going to open in the next 1.5-2 months time. Then it will be Ahmedabad, which will open, say, 1 month immediately after that. And then we have Bangalore and Pune, which will open immediately. Okay. Retail is the prime focus. We have 4 malls which are coming up. So that is in the next, at least for the next 6-8 months, completing those malls and making them operational is the prime key goal for the next 5-6 months, because that's a large investment has already happened there. Correct. So that's one very important thing which we intend to complete in the next 6-8 months time and add a lot to the top line, bottom line.
All right, so that's about an outlook coming in on demand, retail demand ahead of the festive season and the plans that Phoenix Mills has. We take a short break with the news that a couple of these mid-caps are actually spiking. We have Sumitomo Chemical, which has moved to the high point, and 3M India. Now, that's a stock that, doesn't generally move as much, but currently we're seeing a 5% move on 3M India. And the volumes actually have crossed the average volumes as well, the average trading volumes that we see on that counter. So 3M India is the one which has moved mostly in just the last 10-15 odd minutes and moved well with big volumes. We take a short break, come back, get you up to speed on everything around the pharmaceutical space as promised earlier. Well, let's go across to Ekta now, who's moved to the big wall to talk about the 30 drugs, over 30 drugs which were regularly used by patients, which have now become a lot more affordable thanks to the NPPA Act, or the authority which has reviewed about 34 drugs in its 2022 review. Ekta.
Thanks for that. Well, yes, the 34 drugs are totally valued at around 5,000 crores. They range from commonly used antibiotics, diabetic drugs, antifungal drugs, to the COVID-19 linked drug, the antiparasitic ivermectin. Now, the criteria for choosing the drugs are that it should be a safe drug, which is widely used. The NLEM now has a total of 384 drugs across over 25 therapies. And this is versus the earlier list of 376. Now, while the price caps are yet to be decided and will be based on an average of the top-selling drugs, analysts estimate that the prices of some drugs could be reduced by even up to 20%. An example is the diabetic drug insulin glargine. Sanofi's is currently the market leader within insulin glargine, priced at close to 800 rupees. Now, with the inclusion of insulin glargine in the NLEM, the price of Lantus could reduce to a little over 630 rupees. Similarly, we could see a price revision in other large molecules in the list, such as the antifungal drug itraconazole and the antibiotic meropenem. So yes, while the price reduction is a relief for patients, what is the impact on companies? Not much, say analysts. In fact, it is viewed as an overhang being removed, since the next review is expected to be only 3 years later. Also, companies could compensate the price reduction in terms of higher volumes, especially those who have market-leading brands or are the innovator drug brands, as it would become more affordable. And lastly, growth in the other portfolio brands is something companies would look at. And does this impact the Indian pharma industry growth? No. The drugs put under the price control is expected, according to analysts, to be only around 2.5 to 3% of the total industry sales. Of these 34 drugs totally, the growth is also expected to be only in mid to single digits. The IPM growth, which is estimated at low double digits, could reduce to mid to high single digits this year. But in the long run, IPM growth, which has been 10 to 11% in the past 8 years, is expected to continue growing this rate at least for the next decade, led by factors such as higher per capita income, growth in insurance, awareness in rural markets, and of course, higher burden of lifestyle-led diseases.
All right, Ekta, thanks a lot for that. Our regular drugs will perhaps get a little more affordable thanks to the NPPA's revision. With that, we take a short break, come back. Don't lose sight of the markets. Ruchit Jain joins in with some trading strategies on the other side.
Welcome back. Well, let's get talking about the technicals of the market then. Richard Jain is here with us to tell us what he's strategizing at the end of this week. Richard, hi, welcome to the show. First, wanted to start by asking you about a couple of these banking stocks. For example, on a week-to-date basis, IndusInd Bank has done fabulously well. What would you strategize? Do you think that this kind of strength can continue into next week, and hence there would probably be a call on it this week or today?
Yeah, very good afternoon, Ekta. Well, no, specifically for IndusInd Bank, no doubt the trend for the stock has been positive because in spite of these volatile markets, we have seen that the price up moves have been supported by very good volumes. So I think unless we see a complete negative reversals in the Bank Nifty as well, I think the momentum could continue going ahead in the next week as well. And on the high side, 1290, 1300 would be the levels that one can expect in IndusInd Bank. Now, I'll just couple it out with Bank Nifty as well, since we are talking about the banking space. The broader trend for the Bank Nifty has still not changed negative, and it's still on the positive side till that 40,800 important support mark is held down. So I think it's only if we see a closing below 40,800 on the Bank Nifty index, then many of the large caps banks which have seen a good outperformance, we would witness some kind of profit booking in case if the Bank Nifty gives up that 4,800 mark on closing. But till that is held on, I think there's nothing much to worry about in the banking space.
All right, and individual stocks, what would you do? Because we are seeing a lot of stocks actually move, well in today's trading session. Case in point, all these defense stocks, we are seeing a big move. There's Bharat Dynamics, which is up 10%. We have Mcguire Dock, which is, yet another high on that stock, up around 7% odd. Then you have a bunch of these fertilizer stocks doing well too. RCF, for instance, up 5%. What does one do in a market like this where, the overall theme has been that of profit taking, at least in today's trading session, whereas individual stocks are doing well?
So, Mangala, I think that really, one has to be very stock specific and only look for those sectors or stocks which have been outperforming in such a falling markets. Now, with today's gap down opening in Nifty, the index has given a breakdown from a rising wedge pattern, which is usually considered negative, and that implication of that would be seen in many sectors where we would see some profit booking on long positions. But there would be some pockets which would continue to act as a defensive space where money could continue to flow from other high beta names, and I think the defense would be one pack where outperformance could continue going ahead. So starting with the defense space itself, I think GRSE would be the one stock which even at current levels looks much positive because of that higher top, higher bottom structure, good volumes. Even the other stocks, Mcguire Dock and already are up. But GRSE, Garden Rich Shipbuilders could be bought even at current levels with stop below 340 for potential targets around 385, 390 in the near term. So I think this would be one of the pocket where the outperformance is likely to continue. But from the broader markets, I think one should start looking for some shorting opportunities as well because of the breakdown of the rising wedge pattern in the Nifty that we have seen. And hence I have one short call as well, which would be in LIC Housing Finance. Although a recent outperformer, but the readings are indicating a negative crossovers on the daily as well as the hourly chart. So we are expecting some profit booking in some high beta names such as LIC Housing Finance. So one can look for going short in LIC Housing Finance at current levels with stop loss above 444 for near-term targets around 419.
Okay, all right, Richard. Thanks very much for that. So that's the call coming in on the technicals. But let's move on then. Last week's Indigo transaction is being viewed as a very strong example as to why exactly India's block deal mechanisms and rules may need an overhaul. This has reignited the debate for changing the block deal regulations. CNBC-TV18 spoke to a cross-section of stakeholders participating in such deals for their feedback. Mcguire is here with the details on this.
Well, in the recent Indigo transaction, the institutional investors who were lined up by the investment bankers did not receive any allocation, as 100% slippage is said to have occurred in this particular deal. The Indigo case isn't really an isolated case as far as large trades are concerned, as per our dealer sources, some of the recent block deals like IIFL, Max Healthcare, Rolex Links, all have said to have faced a certain high level of slippage. In fact, a certain level of slippage is actually and usually factored in by deal brokers. Let's do a deep dive into how India's block deal mechanism actually works and how the regulator has set the guidelines keeping in mind the interests of all sections of the market. Now, when the next graphic actually shows two designated special windows that are allowed during the day for block deals with restricted and predefined price ranges that allows just for 1% variation. Now, this is mainly done to ensure retail investors are not at a disadvantage and no foul plays occurs. Now, when you're talking about a transaction like the Indigo trade, which is priced at greater than a 1% price variation, this typically happens on screen, and this actually happens outside the block deal window, leading to a possibility of a slippage. So then how exactly do slippages occur? Now, regulation ensures that no single order greater than 10 crore can be punched in during market hours. So a 300 crore deal would typically be sliced into 30 similar orders, and this occurs both at the buy as well as the sell side. Now, this typically allows informed market participants and sophisticated algos to put in their trade above the pre-decided deal price, and the 10 crore order limit is also aimed mainly at eliminating fraud as well as fat finger incidents that may cause large dips as well as large spikes either way in the stock price. But however, let's have a look at some of the other markets and how exactly they do facilitate block deals and where India is lagging behind. When you're talking about Australia, there is no real restriction that has been placed as far as the price is concerned, while Singapore, the deal states that the deal should only be done at a fair market value. Japan, in fact, allows for a much wider price variation, a plus to minus 7% variation from the previous day's closing price. Now, brokers in India have in the past and for a long time made presentations to SEBI and representations to actually go ahead and ease the regulations. They say typically slippages occur not due to retail investor participation that is capped up to 2 lakhs, rather by much larger well-informed HNIs and ultra HNIs who take advantage of the on-screen variations as far as price is concerned. Some of the suggestions made by brokers include having a separate block deal window and allowing for order matching, which they believe will go a long way in solving this particular issue of slippages that are typically seen in large transactions.
All right, take that point. Interesting analysis out there, Vivek. Thank you so much for bringing us up to speed with the slippages that take place in the block trade and specifically telling us about the regulations in other countries as well. With that, we'll step into a short break. On the other side, excerpts from our exclusive conversation with JP Morgan's think tank. We had Sanjay Mukim, Madhav Kalyan and Sajid Chinoy.
Welcome back. Well, definitely pressured for the markets at this point. So we have the mid-cap index, which is down around 1%, all 1.3% at this point. Just want to pull up Gland Pharma because that particular stock stands out. Gland Pharma, in fact, has been in focus because of concerns on liquidity when it comes to its parent company, Fosun. But I have been talking to some sources. Remember that Gland Pharma, in fact, is owned by Fosun Pharma, and the concerns which are emerging with regards to liquidity, etc., is on Fosun International, which is basically the holding company of Fosun Pharma. So the street sources close to the company have indicated that the real problem or the issues probably which have risen are on the holding company front, which holds Fosun Pharma, and not really on the direct company that holds Gland, which is Fosun Pharma. So that stock still, however, a little pressured, so down around 0.7%, had a rough week this week. But let's move on to a CNBC-TV18 exclusive then. Our colleague Lata Venkatesh spoke to the top team of JP Morgan, Sanjay Mukim, Sajid Chinoy and Madhav Kalyan of JP Morgan India to discuss the outlook for India as well as the global markets. Let's get you a part of that conversation.
I think India is an important point of discussion in boardrooms because of a set of factors. One, there is slowing global growth, and this is a market that offers huge growth potential. That continues to be a part of this conversation. When we talk to MNCs worldwide, we hear that consistently. The second is, even as they are looking at diversifying supply chains, India figures prominently in the conversation in the context of what we've done with PLI. But these are slow and deliberate conversations because this is a large investment that comes in.
Yes.
And so while the conversations are very promising, and we've opened up 28 odd sectors, 7 or 8 we see very good traction in the conversations that we're hearing. Okay. Private equity is always, it follows its trend.
But
they do make
private equity is using the domestic rally to exit. Do you see that as a trend that will continue?
I don't believe so. What we see is private equity moving to public markets is a maturity of a company's size and the continuum of what really needs to happen. We are in fact seeing a lot of private equity conversations that are around control and control transactions in multiple sectors. We're seeing that in healthcare, we're seeing that in financial. They want to get their heads in. They see it as an opportunity to build scale, get in with control, consolidate other plays, and we continue to see significant private equity interest. There are some of the biggest firms going and raising India-only funds at this point in time. So we don't see them actually, exiting
looking for an exit opportunity.
A market offers an opportunity, obviously they will look at opportune ways to harness the investment that they make.
But those are tactical, they strategically want to get in. Okay, I read your reports, Sanjay, and what seems to worry you is perhaps Sajid telling you that this is a K-shaped recovery. That means, the GDP may have grown only 2% or 3% compared to 2 years ago, but an outsized portion has gone to formal companies, to the rich. How does that drive your investment picks?
So it's a very interesting question, Lata. And for a while, what we had been arguing is you follow the economy and you look at companies that benefit from that K-shaped recovery and sets of consumers. And therefore, we were very aggressively underweight the staples, for example, because we'd argued that the outcomes will be poor. At the moment, we've taken the contra view. Okay. Right? And this is because my investment thesis is very simple, especially if you are like a one-year investor, is you don't just buy growth. Growth is for private equity or 3-year, 5-year investors. Long-term, India looks great, as all of us have tried to highlight. But in the short term, what matters are earning surprises. Okay. What companies deliver versus expectations. And where is that? And so expectations are very high. And that is the big problem at the moment.
For the discretionaries, for the sectors catering to the rich.
Exactly. So while that momentum is true, and we updated that data last week and in our note, and it's still valid that the recovery trajectory for the richer cohort is faster than that for the, let's say, the lower income cohorts. But the expectations of growth from companies exposed to that rich sector now are very high.
Okay.
And any sort of sanity checks will tell you that in 2 quarters, you're starting to get a huge bunch of potential downside risks to numbers.
Okay. So then where is the positive surprise, if any?
So our first of all starting point is that the market looks very toppish, right? Okay. And again, I keep going out to clients and say, look, let's not confuse the promise, which is a 5-year, 10-year, 7-year vision, with what is going to happen to markets in 3 or 4 quarters. Yeah. So there are 2 or 3 separate drivers of those outcomes. And India's market exceptionalism that we've got, because India outperforming China, I can rationalize. India is now outperforming the SPX in dollar terms. Very difficult to explain, because the SPX is cheaper, it's got better earnings growth in the short term, and it's a hard currency asset. Yes. Right? So this looks very tenuous to me, and at some point there is a risk of a bit of a catch-up. Okay. So our portfolio positioning, therefore, is large cap, quality, defensive kind of stocks, which would be, let's say, the banks, the staples, and if you want some growth, maybe some real estate to add to that.
I'll come back to the banks argument after analyzing, rupee and rates. How would you worry about the rupee at all, Sajid? Trade deficit is an issue. But at the moment, financing is coming. FIs are biting.
I would not worry about the rupee. There is no need to panic. This is not 2013.
CNY is over 7.
Yes, yes. Because we're seeing.
So should we not catch up?
So 2 different things here. We're seeing the strongest dollar, the DXY index, in more than 20 years.
Yes.
And when that happens, all emerging market currencies, all developed currencies will depreciate. And this may not stop anytime soon because the Fed has potentially much more distance to go. Now, the rupee discussion has to be, should we be using the exchange rate as a shock absorber? And I believe we should. When you have a current account deficit that's quite elevated and expected to remain elevated, there are 2 ways to bring it down. Either you really squeeze growth and demand and imports, which is not ideal, expenditure restraint, or you use expenditure switching, where you let the real effective exchange rate depreciate. Over time, exports pick up. Over time, imports are replaced by domestic substitute. Call an expansionary reduction in the current account deficit, right? So my hypothesis is always, let's do that. And I think one other point I'll just make is, remember, the current account is inextricably linked to the fiscal deficit.
Okay, well, some wealth of opinion coming in from the JP Morgan top team there. For the market still pressured, we'll do one thing, take a break. On the other side, shift focus from equities to commodities. Manisha Gupta, commodities editor, will be joining in. Stay tuned.
Welcome back, and joining us on the show now is Peter Mcguire of XM Australia. Peter, hi, thank you for joining us. I want to start with the gold prices trading at a 2-year lows now from a high of 2,052 to 1,660 right now. Is quite a bit of a climb down that gold is done, and we are waiting for yet another interest rate hike. Would you say this is exactly what the gold is factoring in right now, a 75 to even 100 basis point rate hike?
Well, good afternoon, Manisha. Yes, absolutely. And I won't be surprised. 3 weeks ago, you wouldn't have thought there would be any chance of 100 basis points. And now I think that's where the tide is turning. So no one's going to be surprised if Jay Powell and his team hit for 100. Gold has really been hammered, and King Dollar is reigning supreme. It's just been one-way traffic. Have a look at the rupee, have a look at yen, see what all the currencies are doing. And yeah, I think there's further upside yet for that King Dollar, Manisha.
Well, yes. At 1,660 now, what is the kind of strategy that you would advise for gold? Are we headed further lower down here? Should you wait if you want to buy for an investment point of view?
I wouldn't be surprised to possibly wash a little bit further out. It's been hit pretty hard, and that momentum is certainly softer. It's hard to find a floor at it. Might be a 1640, 1630 handle, but I think the gold's good days are ahead of it. I'm not suggesting that anything is, too negative about gold, but at the moment, there seems to be a lot of pressure on dollar up, gold down, and that seems to be the trade at the moment, Manisha.
So, Peter, if somebody wanted to make a strategy, usually it is about markets factoring in, and when the event actually happens, you see some relief buying coming in. Is that what you're expecting for the next 1 week?
Well, I think that at the moment there seems to be a little bit further softness, and I won't be surprised. I've got to just see what happens as far as Powell's comments and what happens, geopolitically, and all the big themes running across from dollar, and how much further upside as that dollar got in the short term, and that's going to be the dampener for gold. So I won't be surprised to go a little bit shorter yet and wash out a few more bucks.
And for the dollar index, what kind of levels are you anticipating? I mean, I was reading reports about 111 and 13 and beyond.
Manisha, it's now at 110. I mean, it's 109.81, and I think that's probably got the potential to be at 110 tonight. So there we go. So it'll be a 111, 112, 113, I think, of the new handles. Everyone's saying you could see euro sitting at 97.5, 98. So there's that, and pound going to 112, 110. And yen is the new line in the sand, 150. So, yeah, dollars really, I see on the screen there, 109.89. So it's bid up. And, yeah, I think tonight will be a stronger dollar, 110 for sure.
For the Indian markets as well, it's below 50,000 rupees per 10 grams is where we've seen the gold prices come in. And yes, the investment demand, the jewelry demand clearly seems to be picking up as we are into a festival season right now. And the wedding season begins from the mid-October, November 1st onwards. Peter, what's your sense also on silver? Because that really seems to be following the other base metal prices, which clearly aren't doing that great as well. After that initial pullback from the kind of lows, we haven't really gone anywhere in sense of direction for the base metal prices. But I'll start with silver first. And how do you see it as it trades below $20?
Well, it's currently, I got silver on COMEX just under 19 bucks at 18.97, Manisha. So I think there's probably further upside for that. It's well down, and it's probably good buying. If you're buying for a longer term, then silver's the one, and certainly for physical. And I think the same for gold, definitely. But yes, the base metals, everything's dragging lower. Dollar's raining, and that's where everyone's hiding to. So yeah, the silver market's probably got a little bit further softness, but when you're looking at that big ratio, gold versus silver, you'd have to say silver's fairly cheap at the moment.
All right. And how are you looking at the overall base metal prices? And at these current levels, what's your sense? Is there a buying opportunity here, especially for something like an aluminum and zinc, where we hear more capacity cuts continuing in Europe?
Well, exactly right. So they've been well and truly hit hard, and they've really come off, big pressure to the downside, certainly with aluminium, and even copper's come back at, 7,700 a metric ton. So, yes, it'll be good buying opportunities. I've got to see what's happening as far as China, Manisha, and, the overall themes coming out of there. They're certainly worrying about their property market, the global demand picture. We've just got to see how that all beds down over the next month or so. There's a lot of uncertainty out there, and I think this lead up to Christmas is going to be one for a lot of big volatility moves.
Okay.
Okay, all right, Peter, as well as Manisha, thanks very much for joining in and taking us through the entire commodity space. For the Bank Nifty, just watch out for that particular index because now that's trending a little bit lower. It's at the low point of the day, down around over 0.5%. We have the mid-caps, like we've been pointing out, the resilience is given up largely in today's trading session. So down around 1.4% currently for the mid-caps. The Nifty currently at around 17,655 points, shaved off, 200 points plus shaved off on the Nifty. But let's now put the spotlight on the auto sector. Tata Motors expects good double-digit growth in FY23 for the commercial vehicle segment. Speaking to CNBC-TV18's Parikshit Luthra from the sidelines of the SIAM convention, Tata Motors Executive Director Girish Wagh adds that the chip shortage issue is now behind to a great extent, but remains something to monitor. Also talks about the EV expansion plans. Listen in.
After the peak of FY19, the commercial vehicle industry saw 2 years of downturn, and compared with the peak of FY19, in FY21, we saw almost 50% growth or decline from the top. So therefore that low base, FY22 was the first year when we saw some 27% growth. And now we are in FY23, we see that growth momentum continuing.
I would also like to ask you about some of the issues with regard to input costs. Do you see that stabilizing or that continues to be on the higher end, putting pressure on your cost of manufacturing?
Right, so I think if you look at various commodities and the basket of commodities that we buy, I think steel has been on a very high level, right? It seems to be stabilizing, but is still at a high level. We expect that the steel prices should go down in the second half. The other commodities are essentially the precious metals, which are used in the after treatment of the vehicle. So they have been on a downturn, so to say, from Q4 of last year, and we expect those to remain at that level.
You have started rollout of your electric vehicles, alternate fuel vehicles. Give us a sense of the number of products in the EV segment, in the alternate fuel segment, that you'd like to bring in the remaining part of this fiscal and next year.
Right, so I think we believe, and even in today's convention it was clear, that the transition to zero emission vehicle in commercial vehicle industry is going to be through alternate fuel. And then in alternate fuel you will have, CNG, LNG, bio CNG and so on and so forth. So I think therefore we are getting ready for CNG across the range. We were already present in small commercial vehicles and intermediate and light commercial vehicles. Just 10 days back, we've also launched the first CNG truck in medium and heavy commercial vehicles.
Right.
Following this, I think most of the closed loop usages, irrespective of the segment, we see that there is a potential to move towards electrification. The reason being, I think most of the end user companies also have their net zero goals. So they also want to transition towards zero emission vehicles.
Also, sir, when it comes to capacity ramp up, you're saying that you're working on a tender for 5,000 electric buses for CSL. CSL will now also come out with a 10,000 bus tender because they're getting a lot of demands from states and different small towns as well. Are you now getting up for a capacity expansion when it comes to manufacturing electric buses? Is the present capacity at Tata Motors enough, or would you need to acquire more?
So, as far as electric buses are concerned, we should look at capacity in 3 buckets. The first is the rolling chassis, wherein we don't have a constraint. The second one is the bus body, right? Again, there we don't have a constraint because we have 2 subsidiaries which manufacture the bus bodies. I think the area where we need to ramp up is the electrical aggregates, that is batteries and traction motors. So that's where we are working with our supply chain within the country and outside the country to ensure that we are able to ramp up to the extent that is required to meet these requirements.
Okay, so that's management of Tata Motors, and with that it's also a wrap on Halftime Report. Business Lunch up next. Stay tuned.